As a reminder, my name is Jason. I am the founder and managing director of Thunder.vc. We use AI to help founders identify which VCs and investors they should be focusing their time on. And today we have Kyle and Rahul joining us to talk to us about data-driven insights that all startup founders need to know when it comes to managing their KPIs and data stacks. Joining here. Excited to have you guys, excited to have you share your stories. But if before we jump in, if each of you could give a quick intro and kind of your background, and and then we'll go into the actual content. So Kyle, we'll start with you.
Yeah, sure. So I'm Kyle Doherty. I'm co-founder of R&D Consulting, RDC for short, with Rahul. We're a full stack RevOps and analytics agency. So we help specifically for startups. So we help them with everything from their strategy and go-to-market stack to lifecycle lead scoring and segmentation, as well as all their analytics needs. So whether that's revenue analytics, product analytics, or even data operations and engineering. So my background, I used to be a full stack engineer that moved over to marketing ops and growth. And then I worked at several different startups with Rahul, and we kept seeing the same problems over and over again, specifically with data and their stack being frankly a mess, and that's slowing down startups' ability to grow. And so that's me in a nutshell. So I'll hand it over to Rahul to give his background.
Rahul, you're muted.
Thank you. Yeah, my background's pretty similar. I'm a former data scientist. Started really in that path as data scientist and statistician. And after that, I was an operator in both BizOps teams. So at Intercom, I was one of the senior managers for business operations, handling things like pricing, segmentation, new product launches. And then I went to Trusted Health, where I again worked with Kyle. And there I was in more of a leadership role and founding role, starting the business strategy team and the business intelligence team there, and really building out their data function from scratch. And as Kyle was mentioning, we again ran into this problem of, okay, we don't have good trustworthy data and good core reporting that enables us to scale. So, we've repeatedly seen this problem as ICs, operators, and leaders, where you find that you're struggling with these sort of RevOps issues that Kyle mentioned, running from just what are the right strategies and processes, all the way to like, do I have the right tools in my go-to-market stack in terms of CRMs like HubSpot and Salesforce, to, okay, do I have the right analytics capability from the SaaS reporting that we'll be talking about today, all the way to product analytics and even data engineering. That's what, as Kyle mentioned, that's what motivated us to start RDC. We really wanted to tackle these problems we kept running into as operators and leaders of startups. So yeah, excited to speak with you all today.
Nah, Matt, I'm glad you're here. And I'm guilty of some of the early mistakes a lot of founders make, myself, when it comes to setting up the early infrastructure for tracking these types of things. Everyone's kind of like, go, let's get to market. But, if you don't really know your numbers and know what actually drives the growth of your overall revenue, top line, and whatever your KPIs might be, you could be missing out on a lot of opportunities. But also, it's like, if you try to go out and raise and you don't have these stats, especially if you're a SaaS company, if you don't know your SaaS metrics, it's pretty much dead on arrival for any kind of fundraising efforts you might put together. And that's why I brought you guys here, and kind of want to have this session to kind of be able to walk founders through what the basics are of what they really need to take into consideration, and what kind of stack they might need to enable that for their particular product and business. So with that all said, I would love to just go ahead and jump right in. So I don't know if Kyle or Rahul, you guys want to take it first, but I'll let you guys run the show from here, and I'll jump in with some questions if we get some questions from LinkedIn or on our Slack. I'll be sure to jump those in.
Cool. That sounds great. Let me just start presenting here, and then we'll dive in.
All right, perfect.
All right. Are you able to see my screen? Jason, could you let me know?
Yeah.
Thanks.
Yeah, okay.
All right. So yeah, we already kind of gave a briefing on who we are. And thanks, Jason, for the introduction. So diving right into what we'll cover today, we're going to be speaking today about 4 reports that are essential to running a SaaS business. So if you're a founder, if you're a revenue leader, or a finance leader, this session is very much for you. Now, these 4 reports are ones that we've often seen startups skip. in part or in whole. And they've paid dearly for that later on, when, to Jason's point, they're not able to tell their investors or to inform their own team as to what's driving their successes or their failures. So these 4 reports, going from left to right, are your revenue model, your cash burn model, your retention cohort report, and your acquisition funnel report. We're going to dive into each of these in turn, and for each of these, we'll have time for questions as well. And as we dive into them, Kyle and I are going to show you worked examples so you can really build an intuition for how these reports work and how you could use them in your own context. Now, one thing I do want to note as well, as we show you these reports, we're going to be using the example of a fictitious SaaS startup. Please do not focus on whether this is a good business or a realistic business. The point is to understand just how do you use these reports to understand the business. So with that said, we'll dive into the revenue model first. Now, the revenue model is a single spreadsheet view of your past, present, and future monthly recurring revenue by its components. So on the left, you can see that we have, your new paid customers that you've acquired in a given month, but then we have your new monthly recurring revenue, your expansion, your contraction, your churn, and so on. And we'll get into that in the live example. Point here is it breaks it down by its components. Now, why this matters is it is the core model to understand your business. In a nutshell, it tells you, how did I make money this month? And if you're a SaaS subscription business, it is a tool to let you plan for future growth, to see what it would take, or to see what your levers for growth are in terms of these individual components. So the main ways you can use this are to set goals that make sense and are achievable, and even path how you'll get there, to map out trends that are happening over time. For example, to understand, is my churn increasing over time? What's driving that? And also to model scenarios at the component level. For example, what would happen if we doubled our new MRR by acquiring double the number of new customers each month that we've typically acquired? So with that said, let's dive in. I'm going to switch now to Equals, our connected spreadsheet tool. So just a quick note about this. You'll notice here that this is a spreadsheet. It looks very much like Google Sheets or Excel, but it is not. This tool, Equals, was created by the first business I hired, Intercom, and their former CFO. It is a connected spreadsheet. It connects natively and brings live data in from HubSpot, Salesforce, and other CRMs, as well as data warehouses like Snowflake and BigQuery, and a number of other tools and platforms. We like it because we can use it to bring all of our operational data in to one place to view and to analyze and to build reports with. We also like it because we can then have multiple core reports. As you'll see here at the bottom, we've got the revenue model, cash burn, and so on, all in one place. So they're connected, they're integrated, they're really part of the system. So we really do like this for that reason. And we'd recommend using a tool like it that brings all your data and all your reporting into one place. So
I just before you dive in, I just want to highlight that. So this is out of the box, connected and integrated with any of the major apps or platforms you're using to monitor traffic, analytics, revenue,
yes,
all that kind of stuff.
Yep. The other thing that's good about it, just real quick, is that not only can you pull in that natively, but it also allows you to write SQL queries and really do a lot with the data without having to do anything crazy like with DBT or creating custom views in a Snowflake data warehouse. So when you're a really early stage startup, you can use a tool like this and sort of forego some of this heavier stack that a lot of people recommend you need. But when you're really, really early, you need the right tools for the size that you are. So we see a lot of companies do one or the other. They either totally over engineer their stack for the size that they are, or they just duct tape things together and it's like a total mess. This sort of allows you to be right in the middle and allows you to slowly grow your stack as your company grows. So that's another reason why we like it.
No, that's awesome. No, I'll let you get back to it. Sorry.
Sure thing. Yeah, and happy to speak more about that at the end as well, or during questions. So diving into the revenue model. If you follow me along here in the top left, you'll see that this model is broken out by months. So every column is a month, starting with column D, which is January 2022, the very first month that this business was in operation. You can see below they got their first 10 new customers there. Then there's February 2022, there are 12 customers, and so on. So every column's a month, and then every row is a different element of the rev model. So you've got your new paid customers, and then we get into your components of MRR. So in January, you've got 5,000 in new MRR from those 10 customers. In February, it was 6,000. And then going down, you've got your retained MRR. So that's just monthly recurring revenue from customers you acquired in prior periods. So it's 5,000 from that 5,000 worth of new customers in January. Now, if we go down here, we've got expansion MRR. So that's of those retained customers, what's the increase in spend they had? And that might be due to upgrades, due to increased usage. In this case, it was 0. There was nothing there. Then there's contraction. What's the decrease in spend for existing customers? And that might be due to decreased usage or downgrading to a simpler plan. Again, that's 0. Then we've got churn, which is customers just churning out, leaving entirely. And this here was 2,500 loss because we lost 5 of those 10 customers we got in the beginning. And something I want to highlight here, because you might be familiar with these categories of MRR, these MRR components. We also do something called net new MRR, which rolls together your new plus your expansion, less the contraction, less the churn. So you can quickly get a handle on, yes, I might be retaining a certain amount of MRR each month. That's steady. Customers are paying me whatever they've paid. But what's the new? Am I, with everything that's happened in terms of new customers, am I existing customers expanding, contracting, or churning? Am I ahead? Is it positive? Is it negative? Is it less than last month? And so on. So we really recommend watching this net new MRR. And then finally, you've got end of period. So end of period summarizes what happened in that month. So just to explain how we got to this 8,500, we had 6,000 in new, plus 5,000 retained from prior periods. That's 11,000, minus 2,500 churned, gets us to 8,500, end of period MRR, which is then retained into the next month, into March. So just want to pause there for a second. Are there any questions at all about how this works, about how these MRR components work, or how the model's set up?
No, I think you guys are touching on things that often a lot of founders just look at current MRR. They basically look at that total MRR for that month, but they don't actually look at what churn, what didn't churn. So I think this is important for a lot of founders to break it out, because ultimately this is, if again, SaaS company, VCs expect these numbers. So if you don't already have them, you're going to want to make sure you have them in the structure.
100%. Yep. So, and so with that said, with this structure set here, folks, let's now move across. So we're in March 2022. Let's bring ourselves to the present day here. Let's take a look at July 2023. So that's the current month. So now, this is 18 months later. In July, we've been in business for about 18 months here. We've done quite well. We're now acquiring almost 400 new customers in a month. Our new MRR is almost 200,000. It's 190,000. It's pretty high. What's really impressive is our retained MRR is 1.36 million. That's a lot. However, as you look at this breakdown, it's also important to note what may not be as high. The expansion, it's actually not a lot. It's only 31,000 a month on a base of 1.3 million, or almost 1.4 million. And the churn, it's actually really low. There's very little churn. It's only 22,500 on a base of 1.36 million. So this is our breakdown right now. Our end of period MRR is about 1.5 million or 1.6 million if you round up. So this is looking pretty good. But the bulk of this MRR, and to Jason's point, you might often look at this total MRR and just say, okay, call it a day. It's important to note here, the bulk of it's coming from retention, from that retained bit. There's not much happening in the expansion front. Churn is minuscule. New is there, but really your retained MRR is what's driving most of this. So then we might say, okay, we understand the breakdown of MRR today. What does it take by the end of the year to hit a goal? On present trends, with these projections here, by the end of December 2023, we're going to have a little under 2.5 million, or 2.456 million. So if that's where we're headed, what would it take to go a little higher? We can now look at each of these components. So Really, the way to think about these MRR components we introduced earlier is they're levers for growth. Let's say, for example, that we did something that you might think is, easier, very quick to get started on. We're getting a certain number of new customers per month. What if we increase that? We got 380 in July. We're projecting only 350 for the next few months. Let's just put that at 400 and see what happens. So if we assume in the next few months, to the end of the year, we're going to get 400 new customers every month. That bumps our expected MRR for December as end of period to well over 2.5 million. Okay, so that's pretty good. We could do something there, and it's not crazy to think that we go from 380 customers that we acquired in July to every month at the end of the year, let's get 400 new ones. That's not too much of a stretch. What about expansion? Our expansion's in the 30,000 range. What if we doubled it from this 32,000 projection to 60,000? We really put more emphasis on upselling. Well, if we did that for the rest of the year, that would get us to almost 2.6 million by the end of the year. Okay, so there's a lever there that we could actually pull. There's some juice to be had there. And then if we look at churn, our churn's actually pretty low. It's only 22,500 in July. We have a pretty conservative expectation of, more in August to 36,000. If we cut that in half to only losing 18,000, that would help a little bit. That would get us over 2.5 million for December. So we can see here, 2.5 million isn't a crazy goal. That's actually pretty reasonable. We have a couple levers to hit that. Now let's try being bolder. Let's say, what would it take to get to 3 million? Can we do that realistically? So let's start at the top here. For new paid customers, we talked about 400. Let's stretch that a bit. Let's say we got 450. We're really doing a big campaign. We might have to hire more salespeople or do more advertising spend. But let's say we can generate 450 new paid customers a month. Very aggressive. Okay. That already gets us to almost 2.7 million by the end of the year. And now let's say on top of that new customer growth initiative, we also look into expansion. We double, like we talked about earlier, to 60,000 per month. That's not a lot, on a base of 1.5 million MRR. So that is not crazy. We could do that. Now we're in the 2.8 million. Now let's say with churn, we get this down to only 10,000 per month. This would require some pretty intense retention campaigns and really assumes that whoever is going to churn, they're unlikely to. Now we're at 2.9 million, but that's some pretty heroic assumptions on the churn front. Perhaps that's pretty aggressive in the expansion front, given that we haven't done a lot of expansion to date. So, 3 million will take some work if we're going to get there. So just to give you an idea, this is how you can use the revenue model to think about what does it take to get to a certain goal that I have in mind? And is that goal reasonable? Are there paths to it? And then we can begin to say, okay, is the juice worth the squeeze? Would it be easier to augment our customer success function to drive more expansion, or to do more on the sales and on the marketing front to drive new customers to our website? Or would it be better to focus on improved support, improved customer success to reduce churn? Where is the juice most worth the squeeze? And that'll depend on your internal operations, your own organization. But now you have a sense of, what are my levers? What can actually happen if I do these things? So I just want to pause there, see if anyone's got any questions at all about this, just how we're using the model, how the model works, anything at all on those lines.
No, I think it's pretty straightforward of just seeing what levers work in terms of where you should drive your attention, what's going to have the biggest impact based on your historicals and looking at your projections. So I think we can continue. Awesome.
Okay, so just going back to our slides here, we're now going to talk about the cash burn model. So this is the cost. This is the cost complement to the revenue model. It's again a single spreadsheet view of your past, present, and future. But here we're going to be showing the total revenue as well as costs. Now, pay attention here because this matters a lot. As a founder, as a revenue leader or a finance leader, you're probably not minding your runway and really watching your burn, especially in times like this. But it only gets harder with product market fit or hypergrowth. We often see startups forget to track this or assume that, I have a budget, one person's looking at it in a silo, that's enough. And we have actually seen startups run out of cash even when they had enough cash in hand or had their fundamentals in a solid place, because they didn't manage this. So the way to use this is to keep track of your runway and your burn rate month on month to really have a sense of your costs, but more strategically to understand if you're default alive or default dead, to be able to project them out into the future and see, okay, am I on a path where without any new investment and without any heroic assumptions about revenue growth, I'll be able to make it. So we'll dive into this now again in the spreadsheet model in equals. So this is our cash burn model. And I think the first thing you'll notice is it's set up the same way as the revenue model. We've again got your months as columns, starting in January, the first month we're in business, then February. And we've again got these blocks of rows that are different elements for the model. So I want to call out one thing that's a bit different here. At the top left, we've got the cash at the start. You can think of this 2 million as your seed round or your pre-seed money. This is what the business started with. And then you'll probably notice this total MRR is familiar. This is coming right from the revenue model. So as things change in the revenue model, as new live data comes in, this will be updated. January 2022, you had an end of period MRR of 5,000 and 8,500 in February, and so on. We've also got a row here for fundraising. So that's your income. And then as we go down on the left here, these blocks in blue are going to be your costs. This should be familiar to you from your budgeting process that you do. We've just organized it a certain way where we've got salaries on their own, benefits and overhead separate. And then we've got recurring spend. So things like advertising, your office rent, your tools like Slack and so on, that you spend on each month. Those are listed as recurring. One-time spend is broken out separately. So this would be things like a security deposit in your office, furniture, new computers, holiday party, etc. Which brings us to the interesting part. Your total burn is just the sum of all these costs. Your cash balance is that cap at the start minus your burn for the month, minus any income. And we track this over time. So your cash balance gets drawn down over time by the burn each month. And then the most important thing below that is your runway. So your runway here in months in bold is calculated by your cash balance divided by that total burn. So it starts out pretty strong. You've got 25, this business has 25 months of runway, but it's drawn down pretty quickly to 18 and 17 and 12 as their costs increase with their growth. And you'll notice here, as we go over time, we're in September 2022 now, it's getting to a bit of a danger zone. You've got 6 months of cash on hand. A good rule of thumb as you're thinking about cash burn is you want to always have more than 6 months of cash on hand. You know, if you're getting down to 6 months, you really ought to be thinking about raising. Ideally well before that. In times like this, you know, some guidance we've heard, and this again depends on your business, is you might even want to have 12 to 18 months on hand at any time. So for this business, they were at 6 months, but they'd already begun the process to raise, because you'll note in December, they suddenly increased the runway to 20 months because they raised a 5 million round. So that is added to their cash balance. They've now got a much bigger cash balance of almost 7 million, and the runway is back to 20, and they're continuing on, drawing down that new runway as we get to the present of July 2023. Now, what you'll notice with this cash burn model is you can project out into the future, just like with the revenue model. So taking these costs forward, we're just taking the average costs for the most recent periods, extrapolating them forward, looking at what the cash balance will be. We can actually see, hey, like our runway is stable at 9 months into August, into September, but later in the year, given our revenue growth, it's actually going to increase. So we're going to start actually increasing our runway thanks to our own revenue growth. And this is good. What you're seeing here is that this startup is default alive. They're not default dead. They're not going to run out of cash if they don't have another infusion from investors. Because they're in this strong position of being default alive, you know, in July, in this present month, they could actually start talking to investors and saying, hey, you know, we'd like to raise on favorable terms. Yes, it's a tough market, but look, we're default alive. We have good prospects. You know, we're in a strong position. We have a much stronger hand to raise than if we weren't default alive. And if there were trouble, they could actually get into their costs and start saying, well, what is driving most of my cost? For example, Snowflake here is increasing quite a lot as their business does. Maybe there's a way to get that under control so it doesn't increase with your revenue. And same for advertising spend. Maybe there's a way to bring that under control. So let me just pause there for a moment. Does anyone have any questions at all about how we've structured the cash burn model? Just some of the examples we walked through right now.
No, I think this has been pretty informative at this point. I'll let you keep going.
Awesome. Okay. So that's our cash burn model in a nutshell. And I'm actually gonna hand it over to Kyle now. He'll go over retention and acquisition and the reporting we've got for that.
Cool. Yeah. Let me start sharing my screen. Cool. So I'm going to go over retention cohort reports. So these reports are going to allow us to dive into our individual cohorts. So in the revenue model, we could see retention, but now we're going to look at the individual cohorts so we can actually manage retention, do something about it. So specifically right now, we're going to look at customer and revenue retention. And we're going to cohort those by the acquisition month. And we all know that this matters because any subscription business, in order to scale or be successful, you have to have good retention. So we have to be able to evaluate retention on a cohort basis and figure out how we're going to improve those cohorts' retention across their lifetime. So we use these reports to understand trends for both the individual cohorts themselves, but also how are the cohorts behaving relative to one another, and what does our retention look like as we add new cohorts as customers. I'm going to jump back into our equals workbook. And what we're looking at right now are retention triangle charts. So what I have here is the first one we're going to look at is absolutely retaining customers by lifetime month. I'm going to walk through how you read these triangle charts. So going left to right, first in column D, we have the acquired month. So January, February, so on and so forth. These are the actual cohorts themselves. The column next to that, column E, we have new customers. So how many customers did that cohort start with? So January, we have 10. Going across the top, we have the lifetime months starting at 0, so the month that they were acquired, and going and as they age 1, 2, 3, 4, as far out as you can go. And so to really understand this, we'll look at an example cohort. So let's start with the June cohort. 2022, we started with 68 customers in that cohort. So in lifetime month 0, we have 68. In lifetime month 1, which would be July for this cohort, we lost a considerable amount. So we are left with 45. And then the lifetime month 2, again, August for this June cohort, we have 44. So that's how you read these triangle charts. Generally, though, when you're evaluating, when you're analyzing retention, you're going to be looking at these on a percentage basis. So the one down here, the triangle chart below, we have percentage retained customers by lifetime month. And we've applied conditional formatting to that. So it's more easy to see any sort of trends or outliers and more easily understand what's happening with our cohorts. So Jason, I'm going to pause there, see if there's any questions. If not, then I'll just keep going and we'll talk about how we would analyze this triangle chart.
No, it's not an analysis.
So here we go. First thing we're going to look at is, are there any outliers? What are we seeing pop? And we can see this March 2022 cohort. Something happened here where this cohort is retaining very well, especially relative to the January and February cohort. So first thing we're going to want to do is jump in and figure out what happened there so we can try to replicate that with our other cohorts. The next thing we have is March 2023. We can see that this cohort is not performing well. It's underperforming relative to cohorts, the newer cohorts. So we want to figure out what's going on there, make sure we can stop that churn that's happening, and make sure that we avoid doing that for other cohorts. Additionally, we can start to compare. We just see how retention is performing overall, and if we're achieving sort of the benchmarks that we set for this business. So for this fictitious business, the benchmark for customer retention would be 60% at 6 months, and that's going to be different depending on what type of business you're in. And so we can see here at 6-month mark, in the early days, this business was not performing well, and in the lifetime month 1. We're having big drop-offs, so we're definitely having some issues with activation. So if we imagine that we are not in July 2023, we're actually in May 2022, and we were looking at this triangle chart, we would say, okay, we definitely need to do something to improve activation so we can stop this bleeding and get retention up to closer to that 60%, which would be good, and even beyond that, closer and hopefully on to 80%, which would be great for this business. So here we've left a note of what happened here. We launched a new activation program for this business in June, and we can see that that started to have an immediate impact on our retention. We no longer are losing as many in that June cohort in the first lifetime month. And that's continuing to improve as we continue our efforts to improve activation. Not only is that helping us with our retention in lifetime month 1, but that's carrying on for the cohorts as they age. And we're now approaching, we've surpassed 60% retention and are now approaching 80% retention for our newer cohorts at the 6-month mark. Again, which would be considered great for this type of business that we're talking about here. So that, in a nutshell, those are the basics of how you're going to use this triangle chart for customer retention. Moving on to revenue retention, essentially it's the same thing. The only difference is now we're looking at how much revenue is retained for that specific cohort. So if we look at an example one here, we have October 2022 cohort has 82,000 in MRR when we acquired them. And the difference with revenue is that this is impacted by contraction and expansion in addition to churn. So with this October cohort, we can see that we started with 82,000, but if we go over to the lifetime month eight, we have 88,500. So we actually increased the amount of revenue that we retained for this cohort, even though we lost some customers to churn. And that obviously would be a result of expansion. So again, we're going to evaluate this using a percentage retained revenue triangle chart instead of absolute. And again, we can see the trends or the outliers that we saw before with the March 2022 cohort and March 2023 cohort. But you also notice that it looks quite different compared to the customer triangle chart. And that's because, again, revenue behaves differently because it's impacted by churn or contraction and expansion. So for this fictitious business, in addition to starting to fix activation in June of 2022, they also decided that they were going to begin actively expanding accounts in June. And so you can see the results of that here in the triangle chart. So for our January cohort in lifetime month 5, which would be June, you can see that the previous month they had a 40% revenue retention, and that jumped up to 60% and then 70%, and that was a result of their expansion efforts. So you can see the impact of the actions you're taking to improve retention both on a customer and revenue basis, and see how that's affecting individual cohorts and your entire business at large in terms of how is it trending? Is it trending the right way? And we can see that we've improved this so much for our cohorts that we're now approaching 110% revenue retention. And for this business, we're targeting somewhere between 90% and 110% revenue retention at the 12-month mark. And we can see that we're trending in that direction. So that would be considered really good, obviously. Yeah.
So I got a question for you. So, a couple in this regard. So obviously this is just a demo, kind
Yep.
of walking through some examples of how to spot data. But when it comes to you're like, all right, you made a decision back in, March or something that, ultimately led to this, turnaround. I guess, how do startups keep track of the initiatives that they make? And when they're looking at a sheet like this and sharing it with investors, what's the best way to note or kind of put that little asterisk that kind of says, hey, we tried this and this is the result?
Yeah, so that's a really good question, because we actually see a lot of times people don't track these things, right? And then they'll see this outlier here or what happened here with this cohort, and they kind of sit there and are scrambling to figure out what happened and piece it together as best they can. Obviously, everyone always says you need to take notes on these things, and again, that's why we like equals, because we can easily add these comments here, and you should be doing that for any of your reporting, whether you're reporting on retention or acquisition, so you can record what happened here. So for instance, maybe with this March 2023 cohort, we had some pricing change that we applied just for that cohort to test it out. and that's what happened there. We would need to make sure that we're noting those experiments we're doing so we can account for these blips that are happening, so that investors or investors, the board, etc., are not alarmed by those. Does that answer your question, Jason?
Yeah, and also just like in teams, you're collaborating with your team, and like let's just say the CFO is reviewing this, and the head of product kind of released a new update, but didn't disclose it, could totally shit these things. So it's just like a note for founders is to properly document major shifts in terms of the consumer experience that would potentially reflect on this. It could be you hired a new salesperson and the first thing was to expand as opposed to acquire new customers, and like when that happened and noting that, whether it's in this sheet or some kind of master doc, that's an important thing to know, especially if someone's working through this on their own without the context of the rest of
Yeah,
the team.
absolutely. That's a great point.
What additional thought there? So Jason and Kyle, when you're mentioning like this master doc, then noting this in context in the spreadsheet, I think it's really important to have that. And one of the things that you're kind of foreshadowing something we'll mention later, we really believe in embedding this in a cadence, so that every week you're seeing, okay, how are we performing? What are the things we've done that might be affecting it, or what are the things that we've launched? So you start to have, an organizational habit of like, we've hired a new salesperson who's focusing strictly on expansion. We did this in week 1 of the month. Okay, and then in week 2 and 3, we're noticing these changes. A few months later, we can go back and say, all right, this was one of our initiatives. Here's how it played out. So really embedding this in the system. And we'll talk about that a little later at the end, but that's the way we really see a lot of this being used. It's like you're systematically tracking what you do, how it affects the business.
Yeah, that's a great point too. Just, one of the other goals of having reporting like this that's consolidated into one place, and like Rahul said, creating a weekly cadence where you're reviewing this, is to break down those silos you mentioned, Jason, so you don't run into those issues. Like, you don't want teams operating in silos. That's where a lot of startups get in a ton of trouble.
Yeah, exactly.
Cool.
All right, I'll let you get back to it.
All right. So the last report that we're going to be looking at is one that I'm sure everyone is quite familiar with. You have your acquisition funnel report. And so this is going to be a foundation report that we're talking about. We're not going to be looking into really detailed analysis, but we think that, or we always recommend that you're looking at 3 KPIs: volume, conversion rate, and days to convert. And we actually see startups that we work with have issues with this. And the reason is two things happen. One, they either don't have their funnel defined. They know they have leads and they have customers, but they haven't documented the steps of the funnel in between those 2 stages. So then obviously they can't track these KPIs. The other issue that we see is that they don't force those stages to be sequential. So they allow leads to skip those stages, and that screws up their conversion rates and their days to convert. They don't have reliable data when it comes to those metrics. So they can't proactively manage the performance of their funnel because they don't know what their actual conversion rates are or time to convert. So obviously this matters because you need to be able to systematically manage the performance of your funnel. Otherwise, you're always going to be reactive and putting out fires, which I'm sure everyone has seen at various companies they've been at. So we use this to diagnose both problems, but also spot opportunities and take advantage of them. And it also allows us to forecast what impact, what the impacts to new customers and revenue are going to be if we make changes to specific stages of the funnel. So same thing, I'm going to jump into our equals workbook. We're going to look at the acquisition funnel. So this is pretty standard. I'm sure everyone is familiar with reports like these. In column C, we have the different stages of the funnel. Across the top, we have the months that we're evaluating. And then for each stage of the funnel, we can look at the volume, the conversion rate, and the days to convert from that stage to the next. And so this becomes really useful. And like I said, it becomes the foundation of doing your acquisition analysis, because we can look at, for instance, February 2022, how many MQLs we generated, MQLs being marketing qualified leads. If you're not familiar with a B2B inbound sales funnel. But if we had a target of 300 for that month, we could look here and see obviously that we missed that mark by quite a lot. And we'd want to start doing a root cause analysis. So there's the first thing we would do is say, did we have enough inputs from the previous stage of the funnel to generate the 300 MQLs we were expecting? And so we would look at the previous month and make sure we had enough leads to convert to MQLs and see if we totally missed the mark there. If we didn't, we had enough inputs, then we would want to then look at our conversion rate and see if something happened with our conversion rate there. This one obviously is a very steady business at 39%, but maybe it dropped precipitously for some reason, and we're going to need to diagnose what happened there. The last thing that can happen is days to convert. So perhaps generally, like in this example, leads only take 4 days to convert to an MQL, but something happened with the leads that we were generating and they didn't convert to an MQL for 14, 21 days, whatever it is. So anyone that's familiar with or has experience managing a sales pipeline is going to be very familiar with worrying about how long it takes someone to convert from stage to stage to make sure you're hitting your goals. This is the same idea, and we see a lot of teams fail to track this, and it doesn't necessarily always impact them at the early stages, but at the later stages, it can have a lot of impact on doing analysis on your acquisition. So like I said, this is super foundational. This is the most basic report we think you need. The next things you're going to want to do to improve this report, first and foremost, you're going to want to layer in targets. So you want to have monthly targets for each of these funnel stages that you're trying to hit month to month. You're then going to want to add weekly and or daily views, so you can stay ahead of what's happening with how you're pacing towards those targets, and you can make changes in advance instead of waiting until the time has already passed and you've missed that target. The other things you're going to want to do is you're going to want to start to layer in segments to this. So we would first want to look at attribution. So we want to evaluate this based on lead created attribution. And we also would want to start asking customers how they heard about us and look at that as an input to attribution. And how you're going to do that is going to depend on the context of your company, but that is a very important thing to do as well. And then lastly, you can start to segment by other segments. As you get more advanced as a business, you're going to start looking at many different segments, and you can slice up this acquisition reporting by those segments to see how different segments perform relative to one another. And if there's ones you want to get focus on less, and other ones you want to focus on more because they are converting at a higher rate, maybe their CAC's lower, etc. So pause there to see if there are any questions about the acquisition funnel report. And if not, we'll move on.
I guess the question I have that hasn't really come up at this point is just like getting this data to start with and knowing what data to pull in, because it's once you have these reports, things become a lot cleaner and easier. But when it comes to like knowing where to pull the data and making sure you're getting the right data, like do you have any tips on
Yeah, so it's a little it's going to be the classic answer that it depends, which obviously everyone hates, but I can say that it depends on where you are collecting this data. If you're sales led, a lot of this data is going to be in your CRM. So it's going to be in Salesforce, HubSpot, etc. And that's where it comes into play, being able to connect this data directly to equal spreadsheet. So over here we have connections, and we can set up connections with individual tools like Salesforce. As I mentioned at the beginning, when I was talking about the acquisition funnel report, you want to make sure that these stages are sequential, meaning you have to go from lead to MQL to SQL, and you're going to need to do that in your CRM generally. If you're more product led and these stages, perhaps lead is a sign up, MQL is a product qualified lead, etc. That's a lot of that. That data is going to be coming out of your app. So you're either going to need to directly connect this data to your application, or more likely you're going to be sending that data from your app database into a data warehouse, and then you're pulling this data from the warehouse into this sheet. So those are sort of the two, at least in a B2B context, where we see this data coming from, Jason. But the details of how to get that data depend on your specific business and the stack that you have set up.
Okay, yeah. Fair enough. You can
cool.
Continue then.
All right. So that wraps up the 4 must-have reports for any SaaS business to be successful. So we covered the revenue model, the cash burn model, the retention cohort report, and the acquisition funnel report. So these are going to lay the foundation, as we mentioned, to be able to successfully run your business. The next steps to be successful with this is you need to do 3 things. You need to adopt a weekly cadence, as we mentioned. So start reviewing these reports weekly to build a habit of tackling things proactively instead of being reactive. You want to build this as an integrated system. So you want to be using the same data for these reports, pulling them into one place and looking at them in one place, which is why we use equals. And you want to treat this as foundational. So this is the source of truth and the basis for further analysis. It's also going to be the foundation to build more in-depth reports for your go-to-market teams. And so therefore you need to make sure you're using data you trust. Otherwise, I'm sure we've all been in places where nobody trusts the data, and these reports then never get adopted and they effectively become useless. So with that, I'll open up to questions.
Well, I think you guys did a great job being able to kind of take us through the weeds of what a company should be producing when it comes to stats and data on their business. And obviously it's a bit more work to kind of really dive in, as you mentioned just a moment ago, of like, okay, well, this is the outcome you need to have. How do you get there? Which if anyone's interested, I'm sure they can reach
Yep.
out to you guys. What would be the best way to get in touch with you
Yeah.
guys?
So the best way, you can either message us on LinkedIn, but you can also go to our website, rdconsulting.io, and you can contact us there via our chat. And we can set up a time to talk to understand the specifics of your business, what the specific challenges that you're facing, whether you need to have this foundational revenue reporting set up, or you need help with your tech stack, or whatever it is. We can help you with that. And we can do a 45-minute free consultation to help understand what's going on with your business and work through potential solutions with you right then and there. And then if you need further help, we can definitely help you, like I said, get your stack, get your data, get your reporting set up so that you can effectively run your business and it no longer feels like you're running through mud to get where you want to go, which I'm sure we've all felt at various companies.
Yeah, and having gone through this at a couple startups, it's a heavy lift your first time if you haven't run these systems before or set them up. Um, I remember my first time we had like 1.5 million users. Well, we weren't at 1.5 million users at the time when we launched it, but we were like getting to like 100,000, 200,000. I was like, oh, like where is it all coming from? How are we tracking it? What's the growth month over month? What's the churn? And I was just like, all right, we need to calculate all this. And that's like when we went out to raise, it was we're pretty much dead on arrival if we didn't have those
Yeah.
stats. And we pitch a couple of people and we get laughed out the room and we don't show like we can speak to it. We're like, yeah, we're going like
Yeah.
this. But as
You're
far
like,
as
how?
like how or what and all that kind of stuff. Like, fortunately, we had a pretty awesome CFO who, kind of helped us get that kind of stuff all squared away and set up the systems to have a pretty good idea. I learned SQL. That was like the big takeaway of being able to extract the data and stop waiting for engineers because we're solving so many very very complex engineering problems. Engineers were not interested in solving, kind of the rev ops and marketing tech problems. We didn't necessarily have like kind of a growth hacker kind of
Yeah.
engineer on the team, which meant I
Yep.
had to figure it out, which was a good learning experience. But this is something that I run into so many companies that I just talked to a company earlier today. It was just like, oh, we have this much MRR, and it's like, well, that's actually not MRR. Like those are transact. You get this much. You're generating this much revenue per month. That's not reoccurring, and like explaining to them the differences and it's very important because like VCs have a very clear understanding of exactly what these numbers mean, and if you don't represent them properly or you don't know what the common VC definition is, and they look at the numbers and they ask you a question and it's not aligned with what the industry standard is, again, that could just be either like a red flag and they, not interested anymore, or it could be something of, a point of contention or concern. So the sooner you guys as a founder get this stuff established and, kind of squared away. Now, if you're pre-revenue and you haven't done anything yet, maybe not so much. But if you're getting to, I would probably say what, 30K to 100K MRR, it's probably really important to have this stuff in place, or at least a rough foundation to where you could use something like
Yeah.
Equals or even just Google Sheets just to put this stuff in. Because otherwise, you're going to be building a business blind, and hopefully it's going up and to the right, and your bank account's growing, more than it's losing money. But it's good to have the insights as to why, and that's why I'm glad you guys were join us and kind of share your insights. Before we wrap up, any additional thoughts or comments to the audience?
Just one thing you
Kyle,
said
or
made me think of something with equals. That's really cool. You were saying you had to learn SQL to pull in all this data. What's cool about SQL or equals right now that they just launched is you can actually, when you're writing those SQL queries with the connection on top of whatever data you're pulling in, let's say Salesforce, you can actually use their AI assist to say, hey, give me a table with this data, and it'll write the SQL query for you and pull the data in. So it's pretty powerful in that regard. So you could be a beginner at SQL and still get the data that you need. And that's something that could be really powerful for startups that are just getting started. And then the other thing I'll say is that I think something you touched on is, if you are really, really early, you're right. A lot of this reporting you're not going to need. If you're pre-product market fit, I would focus on those retention cohort reports so you can understand how you're retaining the few customers that you have. That's going to be a good indication of, do you have product market fit? So you're going to want to know, what's good retention for my industry, and am I starting to retain customers? A lot of people talk about all the different ways you can measure retention or product market fit. One of the best ways is, are you retaining paying customers? So that's what I would say for that.
And not just retaining them from a pay, but are they users? Like, people might forget their subscription, and they keep paying, or it's not a big deal, or they maybe come back. But what really matters is what's that actual usage retention, and that's something that I often ask a lot of startups of, like, we have 30,000 users, and like, okay, well, how many are active this month versus last month? And
that's something we layer. Like, when we work with companies, we start with customer and revenue retention, and then we layer in a very simple measure of who's active or not. You can do that very simply to start with, just, are they going into the app? Are they using the one core feature that you have? A lot of people try to boil the ocean with product analytics, and they really end up in trouble in that regard too. So you want to start small, and you can start to take deeper and deeper cuts as you get more advanced, and as you build the foundations for your reporting.
Awesome. Well, hey guys, really appreciate you joining. Appreciate the insights and sharing your knowledge. For those listening, we have a full breakdown of everything they shared in a blog post hosted on Thunder. You can just go to Funding 101 on our website to learn more, as well as access contact links to reach out to them and potentially request that 45-minute free consultation. So thanks again for
cool.
joining
Thanks
us.
A lot, Jason.
Really appreciate the time.
Thank you.
All right. Bye.
Thank you very much.
Okay. Bye.